If I had to start investing from zero in 2026, I wouldn't begin by searching for the best stock. I wouldn't spend hours comparing charts. I wouldn't try to predict where the market will go next month. Instead, I'd spend my first few weeks doing something that doesn't look like investing at all. That might sound strange, but after watching how successful investors build wealth over decades, I've realized something important. The biggest investing mistakes usually happen before the first investment is ever made. And once that first mistake happens, every decision after it becomes harder. So if I had to erase everything and start over with no portfolio, no investments, and no shortcuts, here's exactly what I would do differently. Because investing isn't just about growing money. It's about building a system that still works when life doesn't go according to plan. Let's imagine two friends. We'll call them Alex and Ben. Both start working in the same year. Both earn similar salaries. Both decide that this is finally the year they're going to invest. Alex immediately opens a brokerage account. He buys a few popular companies he's seen online. He checks his portfolio every day. Ben takes a different approach. He doesn't buy anything during his first few weeks. Instead, he spends that time organizing his finances, deciding what he's investing for, and creating a plan he knows he can follow for years. At first, Alex looks like he's moving faster. He's already invested while Ben is still preparing. But investing isn't a race measured in weeks. It's measured in decades. The investor who stays consistent for 20 or 30 years usually has a much bigger advantage than the investor who starts quickly but gives up after the first difficult year. That completely changed the way I think about investing. Today, I don't believe your first investment is a stock. I think your first investment is your financial foundation. Everything else is built on top of it. So if I were starting over today, that's exactly where I'd begin. Before buying a single investment, I'd ask myself one question. If something unexpected happened next month, would I be forced to sell my investments? Most people don't think about that question when they're excited to start investing. But they should. Imagine your car suddenly needs an expensive repair. Or you lose your job. Or your income drops for a few months. If all of your spare money is invested, you may have no choice but to sell when markets are already falling. That isn't a market problem. It's a planning problem. That's why many financial professionals recommend building an emergency fund before investing aggressively. The exact amount depends on your circumstances, but a common guideline is enough savings to cover roughly 3 to 6 months of essential living expenses. That money isn't there to earn the highest return. It's there to protect your investments from becoming emergency cash. At the same time, I'd take a careful look at my debt. Not all debt is the same. But high-interest debt deserves special attention. Think about it this way. Imagine trying to fill a bucket with water while there's a large hole in the bottom. You can keep pouring more water into the bucket, but a significant amount keeps leaking out. High-interest debt often works the same way. Historically, diversified stock markets have produced positive long-term returns over very long periods. But credit card interest rates can be much higher than those long-term averages. Paying off expensive debt creates something investing can never promise: a guaranteed improvement in your financial position by eliminating a known cost. That's why my first financial wins wouldn't come from the stock market. They would come from making my financial life more stable. This idea isn't exciting. It won't become a viral headline. But history shows that successful investing usually rewards discipline more than excitement. There's another benefit that's easy to overlook. A strong financial foundation changes the way you behave. Behavioral finance has shown that emotions often influence financial decisions. When people feel pressure, uncertainty, or fear, they're more likely to make decisions they later regret. An emergency fund reduces some of that pressure. Lower financial stress makes it easier to stay focused on long-term goals instead of reacting to short-term problems. That's an advantage you can't see on a portfolio chart, but over many years it can make a meaningful difference. Once I'd built that foundation, only then would I move to the next step. Not choosing investments, choosing my destination. Because before you can build wealth, you need to know what wealth is actually supposed to accomplish for you. The answer will be different for everyone. For one person, investing might be about retiring comfortably. For another, it might be buying a home, supporting their children, or simply having more financial freedom later in life. That's why I wouldn't start by asking, what should I invest in? I'd first ask, what am I investing for? Because your goal determines almost every decision that follows. Imagine someone who plans to use their money in 3 years for a house down payment. Now compare that with someone investing for retirement that's still 30 years away. Should they take exactly the same approach? Probably not. The first person may need stability because their timeline is short. The second person has something incredibly valuable: time. And time changes how investing works. Over long periods, markets have historically experienced both strong growth and painful declines. No one knows when those declines will happen. But the longer your investment horizon, the more time you have to recover from temporary setbacks. That's one reason many financial professionals encourage investors to match their investments to their time horizon instead of chasing whatever happens to be popular. So if I were starting over, I'd write down one clear objective. Not 5. Not 10. Just one. A simple sentence that explains why I'm investing in the first place. Whenever I'd feel tempted to change my strategy because of scary headlines or exciting trends, I'd come back to that goal. If the goal hasn't changed, my strategy probably doesn't need to either. Once I know my destination, the next question becomes much easier. Where should I invest? Many countries offer retirement accounts or tax-advantaged investment accounts designed to encourage long-term saving. The names differ depending on where you live. Some employers also offer retirement plans that include matching contributions. When available, those matching contributions can represent an additional benefit beyond your salary. Tax-advantaged accounts may also allow investments to grow more efficiently by reducing certain taxes, depending on local laws. That's why I wouldn't simply copy someone else's investing setup. Their country, tax rules, employer benefits, and financial goals may be completely different from mine. Instead, I'd spend a little time understanding which accounts make the most sense for my own situation. Only after choosing the right account would I finally decide what to put inside it. Years ago, I probably would have searched for the next company that everyone was talking about. Maybe the fastest growing technology business. Maybe a stock that had doubled over the past year. It feels exciting because our brains naturally pay attention to recent winners. Behavioral finance even has a name for this tendency. People often assume that recent success will continue simply because it's fresh in their minds. But investing doesn't reward excitement. It rewards good probabilities. That's why I'd keep my portfolio surprisingly simple. Instead of trying to predict which individual company will dominate the future, I'd focus on broad diversification. Diversification simply means spreading your investments across many different businesses instead of depending on only one or two. Think about owning a small neighborhood grocery store. If that single business struggles, your entire investment suffers. Now imagine owning tiny pieces of hundreds or even thousands of businesses operating across different industries. Some companies will perform well, others won't. But your financial future no longer depends on one management team making perfect decisions. That's one reason broad market index funds have become such a popular choice among long-term investors. Rather than trying to beat the market by constantly picking winners, they aim to capture the performance of an entire market. Research over many years has also shown that, after accounting for fees, many actively managed funds have struggled to consistently outperform comparable market indexes over long periods. That doesn't mean active investing never works. Some managers outperform. The challenge is identifying them in advance and knowing whether they can continue doing so. For a beginner, simplicity often has an advantage. It removes unnecessary decisions. And fewer unnecessary decisions usually mean fewer opportunities to make emotional mistakes. There's another misconception I'd leave behind if I were starting again. Many people believe successful investors constantly buy and sell. They imagine professionals watching charts every hour and reacting to every piece of news. Reality is often much less dramatic. Long-term investing usually rewards patience far more than constant activity. Buying and selling frequently doesn't automatically improve results. In many cases, it simply creates more opportunities for emotional decisions and higher costs. The hardest part of investing isn't learning how to buy. It's learning when not to react. And that becomes much easier when your portfolio is built on a simple plan instead of constant predictions. That's why my next priority wouldn't be finding better investments. It would be building better habits. Because over the next 20 or 30 years, my daily behavior will probably matter far more than my ability to predict next month's market headlines. If I were starting over today, the next thing I'd build wouldn't be a more complicated portfolio. It would be a more reliable system. Because investing once is easy. Investing every month for the next 30 years is the real challenge. That's where consistency becomes one of the most valuable investing skills you can develop. Rather than trying to decide every month whether now is the right time to invest, I'd automate the process. After every paycheck, a fixed amount would move directly into my investment account. The decision would happen once. The habit would continue automatically. That approach also helps reduce one of the biggest enemies of long-term investors: emotion. Imagine the market falls sharply one month. The headlines become negative. Social media is full of predictions about what might happen next. If you're making a fresh decision every month, it's easy to convince yourself to wait. Maybe next month will look safer. Then another month passes. And another. Before long, you've spent an entire year waiting for the perfect moment that never arrived. Automation removes much of that temptation. Instead of reacting to fear or excitement, you simply continue following the plan you already decided was appropriate. This approach is often called dollar cost averaging. It means investing a fixed amount at regular intervals regardless of market conditions. It doesn't guarantee higher returns than investing a lump sum immediately, and research has shown that lump sum investing has historically outperformed more often when the money is already available. But for people investing gradually from each paycheck, regular investing offers an important behavioral advantage. It encourages discipline. And discipline is often more valuable than perfect timing. Of course, even with a great system, every investor eventually experiences something uncomfortable. The market falls. It has happened many times throughout history. And it will almost certainly happen again. The exact timing is impossible to predict. That's why I wouldn't build a strategy that depends on avoiding every downturn. I'd build one that expects them. This is where many beginners misunderstand investing. They see falling prices as proof that something has gone wrong. In reality, volatility has always been part of investing in publicly traded markets. Temporary declines are uncomfortable, but they're also normal. The important question isn't whether markets fall. It's whether your financial plan can survive those periods without forcing you to make emotional decisions. Think back to everything we've already covered. The emergency fund reduces the chance you'll need to sell investments unexpectedly. Managing expensive debt lowers financial pressure. Clear goals remind you why you're investing in the first place. Diversification means your future isn't tied to one company or one industry. Automation keeps you investing without constantly questioning yourself. Notice how every step supports the next one. None of them work in isolation. Together, they create a system that's designed to keep you invested when staying invested becomes difficult. That's an important difference. Many people spend years searching for the perfect investment. Very few spend enough time building the perfect investing process. Yet history suggests that behavior often has a greater impact than finding the next winning stock. Let's go back to Alex and Ben. At the beginning of this video, Alex looked like he had the advantage because he invested immediately. Ben spent time preparing. Fast forward several years. Markets have risen. Markets have fallen. Life has happened. Unexpected expenses appeared. Headlines created uncertainty. Alex reacted to every major event. Sometimes he bought because everyone else was buying. Sometimes he sold because everyone else was worried. Ben didn't know the future any better than Alex. He simply built a process before building a portfolio. His decisions became easier because most of them had already been made long before the headlines arrived. That's the lesson I wish I had understood from the very beginning. Successful investing isn't about proving you're smarter than everyone else. It isn't about predicting recessions. It isn't about discovering secret strategies that nobody else knows. More often, it's about doing ordinary things consistently for an unusually long time. That may not sound exciting, but wealth rarely grows because of excitement. It usually grows because of patience, discipline, and time working together. So if I had to start investing from zero in 2026, I wouldn't begin with the market. I'd begin with myself. I'd strengthen my financial foundation. I'd define one clear long-term goal. I'd choose investment accounts that fit my circumstances. I'd build a diversified portfolio instead of chasing individual winners. I'd automate regular investing. And I'd prepare emotionally for the fact that markets won't move in a straight line. Because confidence doesn't come from knowing what the market will do tomorrow. Confidence comes from knowing your plan still makes sense, even when tomorrow is uncertain. If there's one idea I hope stays with you after this video, it's this. Your first investment isn't the fund you buy or the stock you choose. Your first investment is the system you create. Build that system well, and every investment you make after it has a much better chance of helping you reach your goals.